Welcome to Global Risk Community Chat. Today our guest is Zack Ellison. Well, I'm very happy to have you here today, Zack. Welcome.
Thanks for having me. I'm excited to be here.
Yes, likewise. So before we get into the topic, can you briefly introduce yourself to our audience?
Sure. My name is Zack Ellison, and I am the Managing General Partner and Chief Investment Officer of Applied Real Intelligence. We go by the name A.R.I, and A.R.I is a venture debt investment manager. And we'll get into that strategy a bit later. But in terms of my background, I spent close to 20 years in the investment markets at banks like Scotiabank and Deutsche Bank, and also large asset management firms like Sun Life Financial. And currently I live in Los Angeles, where we're headquartered at A.R.I, but we also have offices in San Francisco and Dallas.
Yeah, sounds super cool. And with that being said, let's then jump into the topic. Today our topic, of course, is venture debt. So let's get into it. So can you explain us what venture debt is and maybe how it is beneficial to investors, but also the founders alike?
Sure, yeah, I'd be happy to. So venture debt is not a well understood strategy at this point, but it's quickly emerging as a key funding option for startups. So essentially, venture debt is loans to later stage startups that are already producing revenue. So typically these are Series B or Series C companies that are generating at least 10 million per year in revenue. And what we do as the lender is provide them with debt capital, and we also will take a small chunk of equity warrants, which will give us some upside participation in the company's stock. But generally speaking, the reason this is really exciting for founders is it's much cheaper to utilize debt than it is equity, and it's much less dilutive, right? So people want to keep the companies they've built, and venture debt gives them the ability to do that.
And what about on the investors' end?
Sure. So there's many benefits for investors. The first is that the risk-adjusted returns are very high in venture debt because the yields are typically double digits in the mid-teens, and the loss rates historically have been incredibly low, less than 25 basis points per year. So you combine the high returns with low loss rates and also a very stable income stream from the debt and low correlation to other asset classes, and you get a great risk-adjusted product that really fits in most portfolios. So the way that most investors think about this is that it typically will go in their private credit portfolio or their income producing portfolio. These loans are typically senior secured. So they're first in the capital structure, at the top of the capital structure, typically collateralized by the assets of the borrower, including intellectual property. And what's really interesting is that these loans are floating rate, which in this environment is very attractive to investors because most folks are really worried about inflation and rising interest rates. And this is the first time in many years that we've had a rising interest rate environment. And so having floating rate notes really hedges against that. And then the equity warrants that are attached to each of these deals also is a good inflation hedge because it provides upside equity participation in these companies.
Yes. Thank you so much for sharing that as well. And of course, I'm hearing things like, inflation or this volatility that is happening essentially in the financial sector and many other sectors. So with that being said, I assume that, of course, there are some risks involved. So can you maybe share some about the current market risks?
Yeah, so the biggest risks in the market right now are global geopolitics, right? We've got war with Russia and Ukraine. Rising interest rates and inflation are at the top of most investors' minds. And of course, there's there's a potential for a turn in the credit cycle, in the sense that we've been in a 13-year bull market. I think that's come to an end, right? So now people are starting to worry about potential inflation and also recession, which combined give you stagflation, right? When you're not really growing economically, you also have rising prices, and that's a very tough environment to navigate through. So really that's the main risk on most people's minds. And what they're doing is smart investors are moving up in quality, right? They're going to safer strategies, safer companies, safer structures, and they're really looking for ways to try to hedge out the volatility that's ahead.
Yeah. And on that note, then a follow-up question: how is then maybe venture debt the risk? Because obviously the risk is for any kind of investment fund or so, but how, especially for venture debt, it is more mitigated?
It's a great question. And a lot of people hear the word venture, and the first thing they think is that must be risky. But the facts actually show that venture debt is one of the least risky strategies out there, with loss rates that are actually lower than investment grade credit. And there's some reasons for that. The main reason is that we'll start from big picture. We're investing in companies that are already backed by some of the top VCs in the world. So the VCs have been investing in these companies for many years before we come in as the lender. So the VCs have essentially done a lot of due diligence on these companies. They've helped them grow. The companies are now producing revenue typically in the range of 10 to 100 million is where we tend to want to invest in terms of revenue. So they're producing cash. They're growing very quickly. And what they're really looking for is growth capital, right? So they're coming to us as a lender saying, hey, we're looking to facilitate growth and reach a milestone, whether that's a strategic acquisition where we're being purchased, or potentially another big equity raise in the future that we want to increase our valuation for, or potentially an IPO. So that said, these companies are very high quality. They're essentially the best of the best. And we're coming to them at the peak of their growth cycle, essentially. And we typically come in after the company has raised cash through an equity round. So typically we're lending about 25% against the cash they've just raised. So for example, if a company wants to raise $50 million total in a Series B or Series C round, they might do 40 million in equity and 10 million in debt. So we as the lender have 40 million in cash that's just been raised, that's subordinate to us, right? That's basically de-risking our loan and helping to ensure that the interest payments are going to be made and that eventually the principal will be paid down. So that's the first thing. The second thing we're looking at outside of the quality of the company and the revenue growth profile is the enterprise value of the company. And typically we're lending about 10 to 15% against the total value of the company. So you take a company that's worth $100 million, they could do everything wrong, lose 80% of their value. And if we've made them, let's say a $10 million loan, they're still worth $20 million, which is 2 times the value of our loan. So we're going to come out whole as the lender. The equity investors, meanwhile, are pulling their hair out or crying themselves to sleep at night because they've lost 80%, but we're fine. So making loans where there's really thick asset cushions, starting with enterprise value, is really important. So we look at the enterprise value, again, lending about 10 to 15% against that. The cash that the company's raised in the most recent equity round, lending about 25% against that. And then also having really strong deal structures that have covenants. So typically there's 2 covenants at a minimum. One is a performance to plan covenant, ensuring the company is meeting its revenue targets. And there's also a minimum liquidity covenant, which ensures they have a minimum amount of cash to keep the business viable. And all that said, we're also monitoring these companies on a monthly basis. So unlike the public markets where you're seeing quarterly financials, we're seeing monthly financials, and we almost always have board observer rights. So we know what the company's doing in real time. And if things start to go off track, we're able to come in and help before things get too far off. So there's a lot of risk mitigants in place. And last but not least, the equity sponsors are typically very supportive of these companies and want to work constructively with us as the lender if things start to go bad. So all that said, when things do go wrong, the recovery rates on these loans are very, very high, typically 80 or 90 cents on the dollar, even for the few loans that do default.
Yeah. Then it to me sounds like venture debt has a lot of benefits and much less risky. So I can imagine that it will be outperforming the other kinds of um, funding on the longer run, but also in the shorter run. So with that being said, I want to go on with our last question, and that is, if you were to be able to share some takeaway points with our viewers that they can start maybe taking action or start implementing, what would that be?
So I think the first thing is that everybody should realize we're in a new environment that a lot of folks haven't seen, because like I said, we're at the end of a 13-year bull market, and interest rates are going to be higher, risk is going to be increasing, and people are going to start taking some heavy losses, and they already are, and I think that's going to continue. So the best advice is to think about risk first, think about preservation of capital, think about liquidity, and within the fixed income space where I'm focused, start to look at structures that offer some type of interest rate hedge. In other words, floating rate structures, so floating rate loans like venture debt or leveraged loans, some other private credit strategies. I would also look for strategies that are less correlated to the broader markets. So looking at niche strategies that aren't going to move with the same beta that some of the public fixed income securities will. So generally that means looking to move up in quality, looking to move to private markets that are less correlated to the public markets, and always just thinking about risk first.
Thank you so much for sharing that note as well. And with that being said, unfortunately, we are running out of our time. So I want to thank you again for joining us today and sharing your insights.
Thanks for having me. I appreciate it.
Likewise. So have a great day.
You too. Thank you.